Hi, class. I hope you're feeling comfortable with debits and credits and types of accounts and financial statements and all of that good stuff. You'll want to review until you're comfortable with it. Today I'm going to go over chapter 3. This is the rest of the accounting cycle. In chapter 2, you did analyze, journalize, post, and create a trial balance. That's the first part of the accounting cycle. And now we're going to look at end of the period. What happens at end of the period? So here's the whole analyze, journalize, and post. So you record and post external transactions. Now you're going to record and post your adjusting entries, prepare financial statements, and do closing entries. So this last column is what we will do this chapter. I want to talk a bit about revenue recognition and expense recognition. What we mean by revenue recognition is that we don't recognize revenue. In other words, we don't record revenue in our accounts, our accounting system, until we've provided the service to customers. That's called the revenue recognition principle. And we follow the same rules for expense recognition. Expense recognition is when we have the expenses follow the revenues. In other words, any costs that were used to help generate those revenues that we record as expenses in the same period in which we recorded the revenues. So we match our expenses and revenues. It's called the matching principle. Here we want to look at cash basis versus accrual basis accounting. So when we talk about revenue recognition, if we are in a cash basis accounting, it's pretty simple. We get the cash, we record the revenue. But in this class, we use accrual basis accounting. That means we record revenue when we provide the goods or services, not necessarily when we receive the money from the customers, but when we provide the goods or services. The same thing with expense recognition. We record expenses under the accrual basis of accounting when we incur those expenses or use those things. But under cash basis, we don't record expenses until we actually pay cash. Now, accrual basis accounting is GAAP, generally accepted accounting principles. Cash basis accounting is not GAAP. So if you're using cash basis accounting, you're not following GAAP. Does this mean cash basis accounting is bad? No, it doesn't mean it's bad. It just means you don't use cash basis accounting if you have to follow GAAP. In other words, if you have a public company or you have produced financials for public consumption. Let's just look at a couple of quick examples. E31. Now these examples are all in your book. I've just put them on a separate document to make it a little easier. But you can open your book and find this example. American Airlines collects cash on June 12th from the sale of a ticket to a customer. The flight doesn't occur till August 16th. And this is common because you typically don't buy the airline ticket the day you fly. Or if you have to, it's pretty expensive. So when do you recognize revenue for this situation? For American Airlines, they would recognize the revenue on August 16th when the flight occurs, not on June 12th when they sell the ticket to a customer. That cash they collect on June 12th is not revenue. It's deferred revenue, which is a liability account, if you remember from chapter 2. Number 2, a customer purchases sunglasses from Eddie Bauer on January 27th on account. So the customer charged it. They got the sunglasses and they charged it. Eddie Bauer receives payment from the customer on February 2nd. When does Eddie Bauer recognize the revenue? They recognize it on January 27th when they provided the goods, not when they received the money. The next one, on March 30th, a customer pre-orders 10 pizzas from Pizza Hut. They're prepared, they order those on March 30th, but they're prepared and delivered on April 2nd. The company receives cash at the time of delivery. This one's fairly simple because when they ordered it on March 30th, we haven't provided a good or a service. Pizza Hut hasn't provided anything. They simply took the order. And they delivered it on April 2nd and received cash the same day. So on April 2nd is when they would recognize the revenue. On March 30th, they wouldn't do anything. There's no entry. There's nothing to do. They simply wrote down an order. Number 4, a customer pays in advance for a 3-month subscription to Sports Illustrated on July 1st. Issues are scheduled for delivery each week from July 1st through September 30th. When does Sports Illustrated recognize that revenue? Well, they don't recognize it when the customer pays on July 1st. They recognize it after each edition is delivered. So they'll recognize it in increments, monthly increments, as each magazine is, or weekly increments as each magazine is delivered. What about expense recognition? American Airlines operates a flight from Dallas to LA on August 16th. The pilot's salaries associated with the flights are paid on September 2nd. When does American Airlines recognize that expense? Well, they recognize it on August 16th when the flight actually flies. So it would be a payable at that point, but it would still be an expense, salaries expense, even though the salaries are not actually paid till September 2nd. Eddie Bauer pays cash on January 6th to purchase sunglasses from a wholesale distributor. The sunglasses are sold to customers on January 27th. When does Eddie Bauer recognize the expense of purchasing those sunglasses? On January 6th when they actually purchase them, or when they're sold to the customer on January 27th? Well, the answer is when they're sold to the customer on January 27th, because you want to match that expense with the revenue. They would recognize the revenue on January 27th along with the expense. Meanwhile, excuse me, that purchase would go into an inventory account, an asset account. It would not be expensed until those sunglasses are sold. On January 1st, Pizza Hut pays for a 1-year property insurance policy with coverage starting immediately. When does Pizza Hut recognize the expense on that property insurance? Well, they don't want to expense the whole year on January 1st when they pay it. What they would do is split that amount throughout the year, and they would recognize 1 month's worth of insurance each month. So they would divide it by 12, and they would have an expense of 1/12 each month. It would go into a prepaid insurance account, and we learned about those in Chapter 2. Sports Illustrated signs an agreement with CBS on January 12th to provide television advertisements during the Super Bowl. Payment is due within 3 weeks after February 4th, the day of the Super Bowl. Sports Illustrated makes the payment on February 23rd. When does Sports Illustrated recognize that expense? Well, the day of the Super Bowl is when they would recognize it because that's when they provided the service. So February 4th. So let's talk about adjusting entries. That's what this entire chapter is about. Mostly, there's some closing entries too, but mostly adjusting entries. Adjusting entries are difficult for students historically. Let's see if we can get rid of that difficulty for you. So adjusting entries are because accrual-based accounting causes timing difference between revenue recognition and when we receive the cash, an expense recognition, and when we pay the cash. So those timing differences sometimes cause the balances in our accounts not to be, they're not correct. They haven't been updated. Before we can prepare the financial accounts or statements, we need to bring those account balances up to date. So there are different types of adjusting entries. There's prepaid expenses, and I'm not going to go through all of this. You can read this. There's deferred revenue. This is in your textbook as well. But I just want to go through the basics and then do some examples and show you what it really means. So we have prepaid expenses. We know we're probably going to have to make an adjusting entry because we used some of those expenses. We have deferred revenue, and we know we're going to have to make an adjusting entry because we might have provided some of that service. We also have something called accrued expenses. This just means we have an expense that we need to recognize, but we haven't paid for it yet. In the same with accrued revenue. We provided a service that we haven't received the cash for yet. So if we look at a list of external transactions, we can go through it and determine whether we need to make an adjusting entry. So if we sold shares of common stock, we probably don't need to make an adjusting entry. But if we borrow money from the bank, we probably have some interest that we need to adjust for because they're not going to loan it to us interest-free. We purchase equipment, it goes on our balance sheet as an asset, we're going to have to expense that somehow. We pay 1 year of rent in advance, we know we're going to have to expense $500 a month. We purchase supplies on account, so we put that in a supplies account. We probably use some of that, so we need to show that we used it. And you can see, you can look at the rest of those. I want to show some examples, and I want to give you some tips and tricks. So this talks about prepaid expenses and the timing difference. I want to talk about depreciation before we go much further. So depreciation is not the kind of depreciation where you bought a brand new car or you bought a car and you drove it off the lot and it depreciated in value. Accounting depreciation is simply an allocation of the cost of equipment to expense. So it's not a valuation process. It has nothing to do with the value of the property. It's about allocating the cost to expense. So if we look at FedEx's balance sheet, they have a bunch of assets. They have 50 million in assets. Well, probably more than that. So they have all these assets. How do they expense them? They expense them through depreciation. And when we depreciate, we post an adjusting entry, debiting depreciation expense and crediting an account called accumulated depreciation. Accumulated depreciation is a contra asset account. Let me say that one more time. Accumulated depreciation is a contra asset account. Most assets you debit to increase. If it's a contra asset, you credit it to increase it, which is why it shows up on the balance sheet as a negative number. Let's do some examples here. We're going to do BE 3-6, 3-7, and 3-9. So we'll start with BE 3-6. At the beginning of, I'm going to make this bigger. At the beginning of May, Golden Gopher Company reports a balance in supplies of $500. On May 15th, Golden Gopher purchases an additional $3,300 worth of supplies for cash. By the end of May, only $300 worth of supplies remains. We're asked to, 1, record the purchase of supplies on May 15th, 2, record the adjusting entry on May 31st, and then calculate the balances in the accounts. So let's do this. So BE 3-6. One, we're asked to record the purchases of supplies on May 15th. So on May 15th, we had purchased $3,300 worth of supplies for cash. First, let's draw our T account. And it told us they had a balance at the beginning of May of $500. So let's put that in there. That was our beginning balance. And then we purchased additional $3,300 for cash. In that entry, we would debit supplies expense. Whoops, excuse me, not expense. Supplies. For $3,300. And we would credit cash for $3,300. Okay? That's what happened when we purchased it. So let's post that $3,300 to our supplies account. Now we've got $3,800 in our supplies account. They told us at the end of May only $300 worth of supplies remain. That means our ending balance was $300. How much did we use? Well, if we had $3,800 and $300 is left, we must have used $3,500, right? The adjusting entry that they ask us to do would be to debit supplies expense for $3,500 and credit the supplies account to show that we used it and to expense what we used. This is the adjusting entry. This entry back here was made May 15th. So this was on 5/15 and this one was on 5/30. So be careful with these problems about supplies. Are they telling you what's left or are they telling you what they used? In any case, you'll need to calculate. If they tell you what they used, you can simply make the adjusting entry. But if they tell you what's left, you have to calculate what was used. Okay? Let's move on to BE 3-7. Hoosiers, a specialty supply store, rents space at a local mall for 1 year, paying $25,200 or $2,100 a month in advance on October 1st. So they paid the whole thing on October 1st. We're asked to record that payment of rent in advance on October 1st and then the adjusting entry at December 31st. All right, let's take a look at this. This is BE 3-7. So the first entry they want is the record the payment of rent in advance. That goes into a prepaid rent account. Remember, that's an asset. And we will debit that for the $25,200. And we'll credit cash for $25,200 because we actually paid it. Let's draw our T account for prepaid rent. We debited that for $25,200. Okay? And now, and that was on October 1st, so 10/1. The second entry is the adjusting entry, and that's at 12/31. This is our adjusting entry. What do we need to adjust for? We need to adjust for an expense. We need to adjust for rent expense in particular. And we need to take it out of prepaid rent because it's no longer prepaid. We've used some of it. The question is, how much have we used? It said it was $2,100 a month, so $25,200 divided by 12 months is $2,100 a month. How many months have they used between October 1st and December 31st? Now be careful here. Don't say 2 months, because you have to look at it and go, well, the whole month of October, the whole month of November, and the whole month of December. 1, 2, 3. That's 3 months, or $6,300. And we will post $6,300 to the prepaid rent account, leaving $18,900 in that account. Okay? One more, BE 3-9. So BE 3-9. Beaver Construction purchases new equipment for $50,400 cash on April 1st, 2021. At the time of the purchase, the equipment is expected to be used in operations for 7 years, or 84 months, and have no resale or scrap value at the end. That last statement becomes important in a later chapter when we have an entire chapter on depreciation. So we're just going to do basic stuff right now. They depreciate equipment evenly over the 84 months at $600 a month. So in other words, $50,400 divided by $600 a month is how they're going to depreciate or expense that equipment. We're asked to record the purchase of the equipment on April 1st and the adjusting entry for depreciation on December 31st. Okay. So they purchased new equipment on April 1st. So 4/1, that's the first thing they asked us to do. When you purchase equipment for cash, you would debit equipment and credit cash. $50,400. At 12/31, this is our adjusting entry. When you do an adjusting entry for depreciation, because that's what we're doing here, you're going to debit an account called depreciation expense. And I'm abbreviating. Depreciation expense. You're going to credit an account called accumulated depreciation. Okay? Accumulated depreciation is a contra asset account, and it is contra to the equipment account. So what we have to do, they told us it's $600 a month. How many months between April 1st and December 31st? And be careful, again, it's the whole month of April and then the whole month of December as well. So it's 9 months at $600 a month. That's $5,400. Okay? That leaves this accumulated depreciation account with $5,400 credit balance. Notice we did not reduce the equipment account. We don't want to do that. So on the balance sheet, it would look like this. It would say equipment, $50,400 less accumulated depreciation of $5,400. So at any given time on the balance sheet, you can tell how much of that equipment they have not expensed yet. The difference between those two numbers, the equipment and the accumulated depreciation, is called book value. The book value in this case is $45,000. Now that's not value, it's not valuation, it's simply the book value. In other words, we have $45,000 left that we can depreciate. Okay. Let's talk about deferred revenues. That's when we receive cash in advance before providing the service. And then we create that account called deferred revenue, which is a liability account. Oops, sorry. So if we look at Lowe's company deferred revenue, there's a lot of money in deferred revenue because this is in millions. That means add 6 zeros. Deferred revenue in a big company like this could be something like gift card sales. Gift cards are not recognized as revenue until someone actually brings them into the store and receives a product for them. So deferred revenue can be a big deal in companies. I just can't seem to only click once. Let's do an example of deferred revenue. We'll do BE 3-10. Suppose a customer rents a vehicle for 3 months from Commodore's rental on November 1st, paying $6,000 or $2,000 a month. So the customer paid Commodore's $6,000 in advance. We're asked to, number one, record that rental on November 1st for Commodore's. Pay attention to who you're doing the entry for. And number two, record the adjusting entry at December 31st. Okay, BE 3-10. November 1st, so 11/1, that's the first thing we have to do. Record the rental, record the cash we received. We're Commodore's, so we received cash. We received cash in the amount of $6,000. This is not revenue yet. It is deferred revenue, which is a liability account. So let's draw the T account for our deferred revenue. Our liability account has a $6,000 credit balance. On December 1st, we do the adjusting entry. Or December 31st, sorry. The adjusting entry, how much of that $6,000 have we earned? It was $2,000 a month in rental. So haven't we earned 1 month's worth of rental from 11/1 to 12/31? Or have we earned 2? Well, we've earned 2 because we've earned the whole month of November and the whole month of December. When we earn revenue, we credit revenue because you'll always credit revenue. Service revenue. And that's going to be $4,000, $2,000 a month for 2 months. We're going to debit deferred revenue. That's a liability account. And by debiting it, we're reducing it. So we're reducing deferred revenue. That leaves $2,000 left in the deferred revenue, which is January's rental payment. At the end of January, we would recognize that $2,000. All right. Let's talk about accrued expenses. So this happens when the company has used that expense or cost, but hasn't yet paid in cash for it. So we need to do an adjusting entry to recognize that expense and the corresponding liability. Two more examples. We'll do BE 311 and BE 312. So, Fighting Irish Incorporated pays its employees $5,600 every 2 weeks, or $400 a day. The current 2-week pay period ends on December 28th, and employees are paid $5,600. The next 2-week pay period ends on January 11th in the following year, 2022, and the employees are paid $5,600 at that time. We're asked to record the adjusting entry at December 31st, 2021. Well, if they were paid at December 28th and we're asked to make an adjusting entry at December 31st, how much did they work that we owe them for, that we need to match that expense to the prior year? So let's do this one. BE 3-11. And this is the adjusting entry at 12/31. We need to record an expense that we haven't paid for yet. Salaries expense. What we do here is credit salaries payable. And it's $400 a day, and there are 3 days. So the December 29th, 30th, and 31st, assuming they all work those days. And we will make that assumption. So 3 days at $400 a day is $1,200. And then you would have a salaries payable account that has a balance of $1,200 in it at December 31st. When the employees are actually paid in January, then that will be reduced. And part of the amount that is paid in January will not be an expense for January because you've already expensed it in December. Okay? And the other one we want to do is BE 312. Midshipman Company borrows $15,000 from Falcon Company on July 1st, 2021. Midshipman repays the amount borrowed and pays interest of 12%, that's 1% per month, on June 30th, 2022. So the following year, they repay it. We're asked to record the borrowing for midshipmen, so we're midshipmen. You have to pay attention to which company you're recording, because sometimes they flip them on you. So we're midshipmen and we're borrowing money. We're asked to record that entry and then the adjusting entry at December 31st. All right. So BE 3-12. So number one is on July 1st, 2021. So 7/1, when they borrowed the money. So we're midshipmen and we borrowed $15,000 from this other company. What did we get? We got cash. We're going to debit cash for $15,000. And we signed a notes payable for $15,000, promising to pay it back. So we have this account, liability account, called notes payable. And it has a balance of $15,000 in it. We're not going to pay any of this back until June 30th, 2022, so the following year. We're not going to pay interest until we pay the whole note back. So my adjusting entry at 12/31 is recognizing that interest expense that we owe on that note. Interest expense. And I'm not going to add it to the notes payable. Instead, we don't want to mix up the actual balance on the note with the interest balance. So we will create another account called interest payable. Okay? We do not combine them. So we will credit an account called, interest payable. How much? Here's what I want you to know, is it's 1% per month. They made that easy at 12%. It's not always going to be that clear cut. So the proper way to calculate interest is to take the principal times the rate times the time in terms of 1 year. So how we do that is we take 15,000. Oops, I think that's 150,000. Let's take a zero off that. 15,000 times the rate. The rate was 12%. And we come up with an amount there. And that amount is $1,800. That's a year's worth of interest per year. I want to take the 1,800 and divide it by 12 months. Equals 150 per month. This is the procedure you should always use to calculate interest. Interest is always given in terms of 1 year. That's where the term APR comes from, annual percentage rate. So you always calculate a year's worth of interest and then divide it down to the months. So our interest expense here from July 1st to December 31st is 6 months worth of interest. So 6 times 150 or $900. So we have interest payable of $900 and we have a notes payable of 15,000. Okay. One more set, accrued revenues. This is when we provide products or services, but we haven't received the cash yet. That's simply this entry for receivables, and we've been doing this. So December 31st, services of 700 have been provided, but we just didn't bill them yet. Customers won't pay until January, but we need to record the revenue in December. So this is that entry where we debit accounts receivable and credit revenue. That's a review. We've been doing that one. Okay? So before I look at this, I want to go back and I want to show you something. Let's go back to our first adjusting entry that we did. So we did, let me just get a different color here, because I want to show you. This is an adjusting entry. Notice, we debited an expense. This is an adjusting entry. We debited an expense. This is an adjusting entry. We debited an expense. This is an adjusting entry, and we credited a revenue. Adjusting entry, debit expense. Adjusting entry, debit and expense. So here's the thing. is every single adjusting entry will include either a debit to an expense or a credit to a revenue. One more time, and this is important. You're either going to debit an expense or credit a revenue in an adjusting entry. Always. It must have one or the other. And you can't have both. When you debit an expense, you're going to either credit an asset account, like supplies, prepaid rent, accumulated depreciation. When you credit a revenue, you're going to debit a liability account or something like that. You debit an expense, you could credit a salaries payable. The common factor there is every single offset is a balance sheet account. So that's a balance sheet account. This is a balance sheet account. This is a balance sheet account. This is a balance sheet account. Balance sheet. Balance sheet. So, furthermore, every single adjusting entry will either be a debit to an expense or a credit to a payable, and the other account in that entry will be a balance sheet account. It will never be cash. You cannot have a cash in an adjusting entry because adjusting entries are to account for the fact that you're not on a cash basis. So, if you remember that as you do adjusting entries, they'll be a bit easier. After you make all of your adjusting entries like we just did and post them to the T accounts, we have what's called an adjusted trial balance. This is where all the numbers are now correct. We go through and update all of our balance sheet accounts, update all of our expenses, our revenues, and we come up with an adjusted trial balance. We prepare the financial statements after the adjusted trial balance. There is an order on a trial balance. So the balance sheet accounts are listed first: assets, liabilities, stockholders' equity. Then dividends are listed, then revenues are listed, then expenses are listed. So the balance sheet accounts are listed first, statement of stockholders' equity accounts, and then income statement accounts. That's how they're listed on here. Oop, back up so you can see that. So our balance sheet and that includes our stockholders' equity. Statement of stockholders' equity, of course, goes over here as well on the balance sheet, and then the income statement accounts. This is important when you're asked to put things in the proper order. Balance sheet accounts, the assets are listed in order of liquidity, which one is closest to cash. Of course, cash is very liquid. Accounts receivable, probably more liquid than supplies, more liquid than prepaid rent, and so on and so forth. Liabilities typically start with accounts payable, and then in order of how current they are. Prepare your income statement, prepare your statement of stockholders' equity, and prepare your balance sheet, which you should be pretty familiar with by now. After you do all of that, we have the closing process. So closing entries transfer the balances of all the temporary accounts. And temporary accounts are revenues, expenses, and dividends. That's it. And it transfers those to the retained earnings account. And if you remember, let's go back. Let's look at the statement of stockholders' equity. See how in statement of stockholders' equity we had this beginning balance and retained earnings, and we add net income and we subtract dividends, and we come up with a balance? The closing entries make this physically happen in the books. it moves the numbers there. When we prepare the financials, we're just preparing financials with those numbers. We're not actually moving those numbers to those accounts. But we need to move net income into retained earnings. And we need to take dividends out of retained earnings. Net income is made up of revenues and expenses. So when we do closing entries, we close revenues, expenses, and dividends to retained earnings. Closing entries reduce the balances of those temporary accounts to zero. So we need revenues, expenses, and dividends to go to zero every year. Otherwise, our revenue account would have our revenues from the time we started business, and that would not be good. It wouldn't make sense. So we need to move all of those things to start the year out new. Closing entries. They're pretty simple. You can make them complex, but don't. This is the only time you will debit a revenue account, when you close it. So if it has a credit balance, you debit it to close it. And you close it to retained earnings. So retained earnings is the offset. This is the only time you will credit an expense account. They all have debit balances. You credit them to make them zero and move that into retained earnings. The same with dividends. So what we're doing is we're closing our revenue to retained earnings, which increases retained earnings, credit. We're closing our expenses and our dividends to retained earnings, which debits retained earnings, that decreases it. So our ending balance is $1,000, which is what it says on our statement of stockholders' equity. And then we create a last trial balance, a post-closing trial balance. And that's just a list of all the accounts and their balances after we close the temporary accounts. So the only thing that's on a post-closing trial balance are your balance sheet accounts. When it's done, it looks like this with the new balance of retained earnings after you've closed everything to it. Okay, one last example, brief exercise 319. So we have a year-end adjusted trial balance for this company, and it shows us these accounts with the balances and asks us to record the closing entries. All right. The way to do this is to just create your T accounts. It's really much better to do it that way. Oops, let me change this back to black. 3-19. So what I want to do is create my T accounts. So I want to, they were listed in the problem, so I want to create retained earnings. And it has a balance of $230,000, and we know that's on the credit side. And then service revenue has a balance on the credit side of $900,000. Salaries expense has a balance on the debit side for $390,000. Rent expense balance on the debit side of $150,000. Interest expense $85,000, and dividends $60,000. Okay, 3 steps. Step 1, close revenue. If our revenue account, we only have one revenue account, that's our service revenue. If it has a credit balance of $900,000, how do I make it zero? Well, I'm going to want to debit service revenue for $900,000. What will I credit? Well, I'll credit my retained earnings. Everything, all the offsets are retained earnings. Okay? Let's post that. Let me do it in red here. So 900,000. That makes that account zero. Let's do the next one. So number 2, close expenses. My expenses all have, I have salaries expense, rent expense, and interest expense, and they all have debit balances. How do I make them zero? I need to credit them. What will I debit? I'll debit retained earnings. I don't know how much yet, so I'm going to leave that blank. I know I'm going to credit salaries expense. I'm going to credit rent expense. I'm going to credit interest expense. And what amounts am I going to use? Well, my salaries expense, I need to credit that $390,000 to make that zero. So I'm going to credit $390,000 and make that zero. My rent expense, I need to credit $150,000 and make that zero. And then my interest expense, I need to credit $85,000 and make that zero. How much will I debit to retained earnings? The total of those, $625,000. Okay? Third step. Close dividends. My dividend account has $60,000 debit in it. How do I make it zero? Well, I'm going to have to credit it. And if I'm going to credit that, what am I going to debit? I'm going to debit retained earnings. And I'm going to credit dividends. That amount that I need to do to make this zero is $60,000. Okay? Now I want to post this amount, these amounts to retained earnings. I want to credit it $900,000. That's the revenue. I want to debit it $625,000. That's the expenses. And I want to debit it $60,000. That's the dividends. So what's my balance in my retained earnings account? $230,000 plus $900,000 minus $625,000 minus $60,000. I believe gives me a balance of $445,000. That's those are closing entries. 3 steps. Close your revenue accounts, close your expense accounts, and close your dividend accounts. And it's easier to just draw out the T accounts and put the balances in them and then determine what you have to do to make those zero. Everything you do gets put to retained earnings. Okay. I hope you've enjoyed this presentation from Chapter 3 and it wasn't too just disjointed. Have a great chapter. Let me know if you have questions. Post in the discussion. You guys are doing a great job. Hang in there.